Good afternoon, everyone. Welcome to Space42's Pro Forma H1 2025 earnings call. I'm Bruno Priuli, Head of Investor Relations, and your host for today. Joining me are Karim Sabah, Managing Director, and Andrew Cole, CFO. Before we start, let me go through the usual housekeeping rules. All participants are currently in listen-only mode, and we will have a question and answer session at the end of the presentation. In the meantime, please feel free to post your questions in writing on the chat as we go through the slides. I'll then read them out during the Q&A session. Please include your name and your organization. You can also ask questions orally by using the raise your hand feature, and I will hand the floor over to you to announce yourself and ask questions. For any member of the media, please share your questions separately with our corporate communications team. Please note that Safe Harbor applies, and a replay of today's webcast will be recorded and made available on our website. With that, Karim, over to you to start us off.
Thank you, Bruno, and thank you everyone for joining. Space42 delivered a resilient performance in H1 with a number of positives heading into H2. Starting with page 5, thanks, Bruno. We're faithfully executing against our strategic plan, which was communicated to our investors late last year. We're prosecuting the 4 core pillars, 2 covering Earth observation and 2 covering satellite communication, and we remain single-mindedly focused on these 4 areas. And I will expand further on this call on our specific progress. Going into the second half of the year, we're building positive momentum when it comes to space services. H2 or Q2 specifically has demonstrated that we can now bring back the business on a growth trajectory. And with the bringing into operation of Thuraya 4 in the second half of this year, in fact, part of the commercial operations have already started July, and the second part will follow in August. And this will accelerate the momentum of space services. We're also making significant progress on our direct-to-device venture with Viasat, and I will expand further on this later on this call. When it comes to Smart Solution, they are single-mindedly focused on developing their programmatic capabilities. The business under-delivered in H1. However, the context is we are, again, single-mindedly focused on seeding programmatic engagement, i.e. engagements that are quite focused on our capability system, present and future, and B, that can deliver multi-year engagement with our customers. A number of these engagements are in the negotiation phase, and we expect positive outcomes over the course of H2 2025. Now, as a reminder, this part of the business covers our Earth observation activities, whether covering the acquisition of data through proprietary assets in space, specifically our Foresight system, as well as through the collaboration agreements we have with international service providers of Earth observation data. The other part of our business is, in fact, capturing this data, running the analysis, and deriving inferences and conclusions that inform decision-making, both in the civilian domain as well as in defense and security. Now, in recognition of the work that we have completed over the first half of 2025, one of our program, in fact, received the Future Fit seal by the UAE Government Development and Future Office in recognition of the innovative and disruptive aspect of one of our capabilities, specifically our Geospatial Analytical Platform, GIX, which was co-developed in tandem with the UAE Space Agency. And this recognition, again, demonstrates the impact that we are creating through our innovations and technologies. And all of this led to a resilience performance. We certainly expect to change the momentum of our business for Smart Solution during the second half of the year, build on the momentum of space services as already experienced in H1, which will sort of continue to deliver a robust performance, and Andrew will expand on that. The point I want to emphasize is one of the important theses that underpin the coming together at Bayinat and Yasat, the legacy organization, was the considerable operational synergies And we can demonstrate through our results today that these synergies are being delivered. And again, our CFO will add more colors on this point. Moving on to page 7, as a reminder, at the start of the year, we initiated the faithful execution of our strategy against the 4 core pillars. The first one is to be and remain the preferred partner for premium geospatial data by deploying multi-sensor assets that would be proprietary and sovereign to the UAE, as well as expanding the network of relationships we have with complementary service providers in Europe and in the US, and we're well underway in this avenue. The second pillar covers our geospatial intelligence AI-enabled platforms and the related services, and I would expand on the progress we have made pertaining to GIQ and GIX. The third pillar, and one of the most exciting we have been working on in the space SATCOM arena, has been our non-terrestrial exploration of a direct-to-device system, an exploration that we have started at the beginning of the year, and we formalized a teaming agreement with Viasat, and I will expand further on that. And last but not least is to remain the trusted leader in secure connectivities, in particular to identify the optimal path for multi-orbit system, and we expect to update the investors on our progress during the second half of the year. We've made significant progress, but I'll leave this to a dedicated communication. Now, I will go over our work to date on standing up the strategic program that fit these 4 pillars. And if you move to page 8, when it comes to core pillar 1 and 2, and starting from the left of the chart, we're proceeding full speed when it comes to building, deploying, and operating our Foresight system. As a reminder, it's a system comprised of 7 spacecraft based on SAR technologies, i.e. a technology that can operate irrespective of the time of the day or the weather, and therefore providing 24/7 information and intelligence as relevant to the commercial domain as well as in defense and security. And also worth to note that this is the most advanced technology available today commercially, and we're one of few operators, and the UAE is one of few nations, probably 5, with such capability presently deployed. In total, we are pursuing the deployment of a 7 spacecraft constellation. Foresight 1 and 2 have now been launched. Further work is underway for the development of the remaining fleet. In fact, moving to our programmatic capability. Earlier this year, we were delighted to announce the standing up and the beginning of the work in our AIT facility, i.e. the assembly, integration, and testing of our SAR satellites in cooperation with ISI on our main campus at Space42 in the United Arab Emirates. And in fact, Foresight 3, 4, and 5, in terms of assembly, integration, and testing, is underway, and with the expectation that Foresight 3, 4, and 5 will be launched later this year. We've also announced the setup of our manufacturing facility for our HAPS platforms. So these are high-altitude platforms that can accommodate either SATCOM or Earth observation payloads. And in fact, we started over the course of July a series of POCs with our end customer in the UAE. So excellent progress on this front. And last but not least, when it comes to core pillar 1 and 2, is the fantastic progress we've made on our geospatial intelligence AI-enabled platform, GIQ and GIX. They are now available on the Azure marketplace, and I just want to remind everyone that when we stood up Space42, these were interesting platforms that were being hosted local systems. It was quite UAE-centric, and our ambition was to take this capability and truly globalize it. And through our partnership and intrinsic relationship with Microsoft through our parent company G42, we were able to very quickly make the platform Azure compatible, and today it is being deployed on a global marketplace. And we expect the full commercialization to follow during the second half of this year, i.e. not only that the platform is available, but the commercial terms under which our commercial clients can access this platform can be operationalized. And again, we're tapping into the formidable experience of one of our parent company, G42, indirectly with Microsoft. Now, moving on to page 9, we've made fantastic progress when it comes to our space-based services strategic initiatives. Thuraya 4, as a reminder, was launched early in 2025, and it's one of the most advanced, if not the most advanced, mobile satellite services spacecraft today in operation. All the deployment activities have performed nominally, i.e., the satellite now is ready for operation. Part of the, in fact, services were initiated early in July, and the second part will be initiated in August, i.e., we'll be able to serve the hundreds of thousands of customers of the legacy Thuraya business. Importantly, this is an asset that follows our template of a dual-use model, and this is a program that is already underpinned by a 700 million government contract starting during the second half of 2025. So part of the service that has already started, and I referred to earlier, pertains to this particular commitment, and the commercial launch is well underway. What is interesting for us is this is not just an augmentation of the Thuraya system or a replacement. This is a truly disruptive solution because it introduces 16 new products that are quite relevant for the different domains we serve, whether it's terrestrial, air, or sea. We're already looking into the next leg of our non-terrestrial network capabilities, and here we're taking a view that doing this in tandem with like-minded partners so that we can benefit from the economies of scale of a shared infrastructure is the way to go, hence our announcement earlier this year with Viasat. And what we're seeking to achieve here is truly a disruptive solution that will enable us now to deliver our services to everyday's mobile devices that are compatible with the 6G standard that is well underway over the 2026-2027 window. In doing so, we'll be moving from an addressable market today of single-digit million potential users to billions of users. And our interest there is threefold. One is to extend the mobility experience that I and everyone on this call and everyone we know enjoys every day so that there is no interruption to this connectivity service. Two, be able to do this with the lowest unit economics. And to do this, we need to deliver and operate a highly performing system and to be able to scale up the system gradually at the lowest unit cost, as I've emphasized. And our thesis there is by doing this through a shared infrastructure, i.e. that is co-owned with like-minded operators who also have an interest in globalizing the MSS business, is the way to go. And we're well underway in this particular venture. And we expect an important announcement to follow during the second half of this year. And last but not least, the work in terms of the manufacturing of Aliyah 4 and Aliyah 5 continues to progress nominally, i.e. we are on track to bring these programs as per the schedule already announced to the market and therefore tap into the 5.1 billion commitment that the UAE government has made vis-a-vis these two missions. And finally, on page 10, I want to remind everyone sort of our principal approach to executing our business. And these 5 principles continue to sort of be our North Star in terms of making decisions about the areas we want to prosecute, how we deploy capital, and how we measure ourselves against our the goals we have set. One is it's about programmatic growth. Even if it's going to take longer, our interest is to prosecute engagements that would be multi-year engagement that allow us to deploy and develop our capabilities in the present and the future. And ultimately, that will have an impact, a positive constructive impact on the business or the activities of the users we serve. And in doing so, we want to make sure we can demonstrate and sustain a differentiation, a strategic differentiation. So we will not prosecute activities that will be just comparable to other activities in the market, because ultimately we want to make sure that not only we're making a difference, but we're making a difference that we can sustain in the present and the future. It has to be capability based, i.e. this is not about a one-off program, but it's about a program where we have a capability that extends not just to one or two end users, but ultimately to a number of customers that we can serve. Hence the importance and the centrality of the idea or the principle of scalability. And last but not least, our investors should be assured that we're doing all of that within a very disciplined financial framework that my colleague Andrew, the CFO, will expand on. And at this point, Andrew, I hand over the floor to you.
Thank you very much, Karim. Thank you. And good afternoon, good morning, everyone attending the call. Thank you for being here. Now present the half-year results. These are prepared on a pro forma basis and they exclude PPA adjustments just for the avoidance of doubt. And to pick up on Karim's point, I think we would characterize the H1 results certainly as resilient. It is true that the revenues are lower than we would have liked. Having said that, we have seen a sizable reduction in our cost base by more than the revenue reduction, and such that the underlying margins are actually higher versus the prior year on a normalized basis. The revenue shortfall is largely coming from the Smart Solutions business, reflecting primarily timing shifts in the execution and award of milestones and certain projects, which are expected in H2. It's quite hard to predict accurately exactly when these will fall. We were hoping they would come in H1. It's looking more likely now it will be H2. But fundamentally, when you look at the overall financials, and I'll go through those in a moment, line by line, they are sound. The balance sheet is extremely strong. You will see that we continue to have significant amounts of cash, negative net debt, negative leverage, a contracted future backlog of $6.8 billion, which is equivalent to about 11 times our last 12-month revenue. And we've also secured, a couple of weeks ago, you may have realized, a $700 million ECA-backed financing facility underpinned by 4 international banks to finance the construction of our Ariane 4 and 5 satellites. Really, I think a signal and a testament in the broader marketplace of the confidence that financial institutions have in Space42 and in its growth trajectory. We then have the income statement line by line. And as I said, you can see the revenues up there are down 17%, which I'll come on to in a moment. And that's all coming from the Smart Solutions business, or certainly most of it is reflecting the shift to the right of certain projects. The next 3 lines, cost of revenue, staff costs and other OPEX, that is the cost base of the company. And if you aggregate those and compare it year on year, you are looking at a reduction in the cost base of about 18%. Now, the other income in the prior year included one-off item, a very significant item, liquidated damages that we were awarded from Airbus as a result of the late delivery of the Thrive 4 satellite. So clearly that benefited the prior year EBITDA, hence the shortfall in EBITDA year on year. But of course, once you normalize the results, the situation is a little bit different. We'll come on to that in a moment. Below EBITDA, we have generally some positive developments. We have significantly less depreciation than the prior year. One of our satellites now, which was continuing to be depreciated last year, is now fully written down, which is why the depreciation is less in the current year. The net financing income is higher as we secure more return on our deposits. And also the share results. This is actually a reflection of the performance of our JVs. We've got a couple of JVs with other parties, SES and Hughes, and they have performed substantially better, as you can see, versus the prior year. So the net profit is down in reported terms, but on a normalized basis, you'll see that it's actually in line with the prior year, despite the revenue shortfall, and at a much higher margin of 23% versus 19% in the prior year. Now, the next page actually shows you the normalized results, page 14. Here we strip out those one-off items, which would otherwise distort the true like-for-like comparison. So you can see on the left-hand side, we had some restructuring costs in the current period. We had them in the prior period as well, but they're generally one-off in nature, so we stripped them off. We also had some merger costs in the prior year, and of course the liquidated damages. So when you back those out, then you look at the true like-for-like performance. The EBITDA is lower because of the lower revenue. Having said that, the margin is higher. And on the right-hand side, we extend that analysis down to the bottom line, to net profit. And here you can see that actually, as I said earlier, the net profit is in line with the prior year with a higher margin. On page 15, we then show you the revenue profile. You can see the split. So it's dominated by the space services business. Now, the space services revenues were slightly down against last year, 4 million. And this really reflects the impact of the T3 anomaly that we suffered in round about April 2024. That effect now is pretty much washed through. So I don't expect that to linger anymore. And in fact, as evidence of that, we saw that in Q2, the space services revenues increased versus Q2 last year by 2%. And certainly In H2, we expect the space services revenue to be significantly higher than H1, more than 20% higher, I would say, conservative estimate. And in total for the year, I would expect the space services revenue 2025 versus 24 to be certainly 6-7% higher than prior year. And that is underpinned by the coming to operations, coming into service of the new Thuraya 4 satellite, which is now pretty much substantially completed all of its in-orbit testing. The smart solutions revenues, as you can see, these are a lot lower. This is not what we were planning for, but it does reflect delays and temporary timing shifts in the execution of milestone projects. We do expect that to come back in H2. H2 has always been a much stronger half for this business. And even in 2024, the H2, the revenues were, at least twice higher than they were in H1. And we certainly expect the performance to rebound strongly as we get those new projects back online, as we get the new contracts awarded, which we are pursuing for H2. When we go to the next page and we look at EBITDA, here, this is the normalized EBITDA, so it is down against the prior year, reflecting the lower revenue. The good news is that the overall cost profile fell faster than the revenue profile, which meant that the underlying margin was preserved. And what we will see in Q2 as the new T4 satellite enters service and a new government contract starts, this is worth $700 million over 15 years, so that's set to start in H2. That will come at an above average margin, so that will tend to favourably impact the EBITDA margin in the second half of the year. On the following page, we show you the contracted future revenue of the organisation, $6.8 billion, which is a substantial amount. This relates to contracts which are already secured, they're signed, we just have to deliver and execute. It's fundamentally 4 or 5 contracts in the main with the UAE government, who obviously have an excellent credit record. And you can see this actually extends all the way out to 2043, this contracted future revenue. So what it does is it gives a huge amount of visibility and security of our future cash flow. On page 18, we then have the balance sheet. The key movers here, and we've actually highlighted them in the box, are the borrowings, which have decreased significantly. Some of you might remember that last year, in anticipation of the first advance payment from the UAE government relating to the $5.1 billion Aliyah 4-5 contract, in anticipation of that, we actually drew down on a temporary basis a short-term bridge of $250 million. We received the $500 million advance from the government in December, and therefore we were able to repay the bridge in January. That is driving most of the reduction in borrowings. Apart from that, we also repaid some of ECA-backed financing on the Thuraya 4 satellite and term loan. And of course, then there's a corresponding reduction in the cash and short-term deposits as well, as you would expect. The other big mover here is the capital work in progress as we continue to invest in our programs, in particular in Aliyah 4 and 5, but also in the last final elements of CapEx on T4. That capital work in progress has gone up. Page 19 then shows you the cash bridge, which I think I essentially covered. At the beginning of the year, we had about $1.2 billion in cash. Now we have about 816. And the reduction is basically driven by the repayment of debt there. You can see that the operating cash flow broadly covers the ongoing CapEx, but the big mover there is the repayment of debt. What we should remember, though, is that by the end of the year, I would expect the cash position to be pretty much back where we had it at the beginning of the year. Reason for that is through the new ECA financing that we've secured, we will look to draw down 300 odd million of that in Q3, possibly Q4, depending on the timing. And we're also due a second advance payment relating to the Aliyah 4-5 government contract, 5.1 billion. Of that 5.1 billion, we expect another 300 million to be paid in advance in Q4. So in other words, the point being that the cash position and the balance sheet of this organization is extremely strong. And as I said earlier, we have a negative net debt and a negative leverage as at the end of June of about 1.8 times. I would expect by the end of the year that to be even lower, that leverage ratio. And so finally, before I hand back to Bruno, just to recap on our financial framework, this governs the principles upon which we deploy capital. And it's underpinned by three pillars. One is organic growth, where we invest in our existing assets, capabilities, and people to drive growth. The other is inorganic growth, where we look at bolt-on acquisitions that strategically give us an edge or bring in new capabilities that we do not have. And we are constantly looking at such bolt-on acquisitions as we speak. And then finally, third is returns maximization through an improvement in the share price, as well as a return to shareholders in the form of dividends. Okay, so those are the three pillars upon which our capital deployment are governed. And with that, I will hand back to Bruno. Thank you.
We will now begin the Q&A section of our call. Please ask your questions, raise your hands, and I'll call you.
Thank you very much for the time. I just had a quick question regarding maybe sell-side research. Has there been any work to get some sell-side brokerage coverage to maybe get the story out?
Yes, Dominic, we have been in close contact with both local and international brokers on research coverage. We do expect one shortly, and of course, we keep working to get more and more coverage and relationship with the banks. We have done quite a few conferences over the first half. We have another 4 upcoming in the second half. So we are out there and we are building on it, and I believe we will have good news until the end of the year.
Okay, great, thank you. And then just quickly, my second question. So maybe if you could talk a little bit more about the monetization of GIQ and maybe just monetization, I guess, for the smart solutions segment as a whole, that'd be great. Thank you.
This is essentially Earth observation, okay, upstream, and then downstream, which is where you actually take the data, you analyze it, and you provide actionable, meaningful insights. And so if you think about it, what we're trying to do, Dominic, is move from what has traditionally been essentially a project-based business, where the smart solutions business has been commissioned to perform ad hoc projects, to provide images in this particular area of interest, or to do this particular analysis over there, and to provide a service which is repeatable and that can be monetized on a recurring basis. And that is the transition that we're going through at the moment. Okay, the GIQ GIX platform. And it's an amazing platform, and it's something which, if you are in the region, I'd encourage you to come and attend our Investor Day, which is scheduled, I think, for the end of October or November. We will give a demonstration on how that platform works, whereby users can actually subscribe to the platform and use the data and input the data of their own, and use the AI tools that can analyze and scrutinize and provide meaningful insights. It's quite hard to explain on a call. A lot easier to demonstrate in real life. If you're available in October and November, we'll be able to show you that. And as you get more and more subscribers using that, then obviously you start to build up a more recurring, repeatable revenue stream. I hope that helps.
So thanks, Andrew.
Very clear.
Yeah, and Dominique, here's sort of one way to think about it. When it comes to upstream, i.e. the assets we own, the business model is one of tasking the asset to capture images, so to actually operate the sensors. And the Foresight system is largely underwritten by a single contract where the end user has committed to a volume of tasks over the lifespan of the assets. So I would say above 85% or close to 90% of the capacity of the system is already committed. So think of it as a very comparable commitment to Alia 4A5, which is a SATCOM. So these spacecraft have a certain duty cycle, i.e. you can task them for, let's say, 50% of the time, so that for the balance of the time they are replenishing their powers, i.e. the energy they have. And for the window where you can actually task them, there's a certain number of images that you can generate, and therefore your client is paying per task and per image generated, depending on the service level agreements. Commercially, this is how it would unfold. In our case, we're fortunate that all the volume of potential images we can generate has already been committed to. But you can sort of translate this into a unit cost that you can multiply by the total capacity available, and you can sort of therefore multiply then by the lifespan of these assets, which is 5 years. So that's the way you can model it, and that's what we expect to see from the analysts who will be covering the companies and be publishing sort of their own view on how we are monetizing these capabilities. GIQ would be similar, i.e. this is a system that has certain AI capabilities run through different data that are generated from multiple sources. And again, it's a matter of now tasking these algorithms to run the analysis. And the analysis, the unit of the service that you're charging is a function of the data that you're accessing, and B is the AI algorithm that you are leveraging to draw this analysis. So you can think of it again as a volume that you are required to or you're capable of delivering, and you can charge per unit. And so we're working relentlessly to make sure that we have a recurring business model that is based on the usage per customer, and ultimately to secure long-term volume with each one of our customers. And we're fortunate in the case of both our upstream, i.e. our own satellites, as well as downstream, i.e. our GIQ, GIX platform, that both of these avenues, upstream and downstream, already underwritten by a significant commitment from our end user. And we expect both upstream and downstream to start generating the related revenue streams during the second half of the year.
Got it. Thank you.
Now over to you, Zayed.
3 small questions from our end. First of all, looking at the smart solutions segment, there is heavy pressure, as you mentioned, in the first half of the year. It's down more than 50% year on year. How confident are you within this business line reverting to the 2024 levels? I know you mentioned there's multi-year engagements, but is it going to be enough to trigger such a strong recovery? I remember even before, a couple of years back, when the merger of Bayanat and Yasat happened, Bayanat was valued even more than Yasat. So you still think this is justified with what we're going to see in terms of recovery? That's one. Second of all, you mentioned the direct-to-device initiatives with Viasat, and it seems these might be substantial. Can you shed some light on potentially the investments that will be done, the size of the investments that will be done by Space42, and whether or not this may impact management's recommendation to re-establish a dividend policy in the near term? And lastly, looking at the OPEX structure, there is some strong cost optimization initiatives. Staff costs drastically down in the second quarter. Other OPEX also has dropped in the first half of the year by 19%. How sustainable are these, or are they going to pick up again once you have the recovery happening in the smart solutions segment? Thank you.
Sure. So let's start with the first one. The short answer is yes. We expect a recovery in the smart solution business on the premise of single-minded focus on upstream and downstream, i.e. our ability to be the preferred provider of relevant Earth observation and sensing data, one, and two, to be in a position where we can deliver the relevant analysis of this data. And the two programs that I've referenced on my answer to Dominique earlier in my presentation are the main engine of this. So in a sense, we moved from a business that was covering a vast array of activities with project-led revenue stream to a business that is based on sustainable capabilities that going forward can deliver a sustainable stream of revenues. And that is a conscious decisions we've made at the start, because ultimately we want to meet or deliver against the 5 criteria on which I concluded my brief presentation today, and on which I conclude all my presentations, including the in-person investors meeting we've had last year. I can appreciate that the transition is a demanding one, but it is the right one so that we can deliver a sustainable business that can scale going forward. That's my interest. That's the interest of every member of the Space42 community, and the interest of the board is a business that can truly scale, not just at the level of the UAE, but globally. And we're only going to be able to do that by being single-mindedly focused on these two capabilities with sectorial applications such as autonomous mobilities and what have you. But you need to start with these two anchors. The benefit of the position in which we are today is we're in the process of deploying these capabilities. We're not fully done yet in terms of the foresight system, the development of GIQ, GIX, so on and so forth. What we do know, and this is something that Bayinat had communicated at the launch of these programs pre-merger, is that the UAE government has already committed substantive volumes of requests and therefore revenues against these two work streams. And once they become fully operational, they will sort of reverse the pattern of the results we have experienced during the first half of the year. So that takes care of the first question. When it comes to direct-to-device, you will have a full answer in the not-so-distant future. We expect to communicate to the market, and I think I've mentioned this during the Investor Day. This is a unique program that I think the industry, not just Space42 and Viasat, but the industry is confronting today as an unprecedented opportunity, and it deserves a dedicated briefing. So I don't want to provide bits and pieces of what it will look like, but the wait is not going to be too long. So I'll leave you with that. There will be dedicated briefing. We will invite in person, to the extent that this is suitable with everyone's schedule. We'll invite in person the analysts who follows us and our investors to be able to be part of this announcement, or they could follow it through the webcast that we will be setting. So I'll leave it at that. But equally important, and to go to your third question, it's all part of the business plan that was approved by the Space42 board of directors, i.e., this is a program that we can fund fully, or our participation in the program can be fully funded through our balance sheet, one. And two, it is perfectly in sync with our financial framework, which includes, among other things, the return of cash in the form of dividend to shareholders. So it is not a zero-sum game.
That's very clear. Thank you, Karim. Just one follow-up question on the OPEX question specifically.
Yes.
Sustainable.
So, Andrew?
Yeah, I could take the OPEX. Yeah, so that's a good question. It's not so easy to compare year on year. And the reason being is because, what you're comparing with is the aggregated results this year with the results last year being two separate companies last year with two different sets of policies and practices and procedures, okay? And also in both periods you have restructuring costs of varying amounts. You have, in the previous period, transaction costs. So what I'm trying to say is that the OPEX year on year is not truly comparable until you strip out these items and start to get to a truly comparable like-for-like a set of numbers. Now, the most significant part of the OPEX, as you know, is staff costs, okay? And no one really likes to talk about it, but we have to. It's a very, very significant portion of the total cost base. And if you strip out these one-off items, which is not the like-for-like comparability, different policies, different amounts of staff costs that capitalized from one period to the next, different bonus policies. When you strip these out and you look at the pure baseline staff costs, then those are down considerably. The headcount's down 11%, and the actual cost of staff costs is probably down in the region of about 20%, $10 million or so. And so in answer to your question is, it's hard to see necessarily all the savings come through in this period, but I think from next year, where you have a clean set of like-for-like comparisons, it will become increasingly clear that the measures that we're taking to optimize the cost base are bearing fruit. Does that help?
Yes, that's clear. Thank you, Andrew.
Do we have any outstanding questions? Thank you all for your time, interest, and thoughtful questions. If you have any further questions, please don't hesitate to reach out. We look forward to connecting again soon. Have a great rest of your day. Thank you.